You've saved up, you've done your research, and you finally decided now is the time to invest. And then the market collapses. What happens next? How long do you wait? How much worse does it get before it gets better? And here's the question that you really need to ask. Does it matter how much you invested, or just that you invested at all? Today we're going to deep dive into the data. No opinions, no theories, actual index data going back nearly a century across 6 of the world's most important stock markets. We're going to look at crashes through 3 different lenses. How bad were they? By which I mean a 20% drop, a 30% drop, a 50% drop. How long it took to recover, and whether dollar cost averaging, spreading your investment over the crash period instead of going in all at once, actually shortens the pain. And these answers, I promise you, are really interesting and more nuanced than almost anything you'll find written about this topic. Let's go. Before we get into the data, I need to set out exactly how we're measuring things, because the definition of recovery is one of the most misunderstood concepts in investing. So what counts as a crash? For this video, we're going to look at 3 specific thresholds: a 20% decline, a 30% decline, and a 50% decline from previous all-time highs. Each of these feels meaningfully different. A 20% drop happens fairly regularly. A 30% drop starts to feel generally alarming, and a 50% drop that makes people seriously think about whether they should be in the market and investing at all. And what's actually misleading with this is that maths makes these large market crashes even more brutal. For example, a 20% drop actually needs a 25% gain to recover back to where it was. A 30% drop needs a 43% gain, and a 50% drop needs a 100% gain. So you're going to need to double your money just to break even after a crash, which means it's potentially going to take quite a while. So what are we counting as a recovery? We're using the simplest, most honest definition, the date at which the index first closes back above the level it was at before the crash began. No inflation adjustment, no dividends, just is the number on the screen from the index higher than it was at the peak. Obviously, there's other factors that may influence that, such as whether or not you're including dividends, if you're accounting for inflation, things like that. But for the purposes of this video, we're not. And then what is dollar cost averaging? Dollar cost averaging means instead of investing your whole budget at once, you invest a fixed amount at regular intervals over a period of time. In this video, the comparison is fair. You have someone that might put a lump sum in just as the market crashes, and you want to know if averaging that lump sum out over the market downturn and the market return back to where it was actually saves you any money. The only problem with this is actually by dollar cost averaging, you're riding the crash down and riding the crash up. And so you're actually missing, often if you're doing it consistently, missing a large portion of the returns that you get when the market goes back up again. Okay, let's start with the index fund that most people think of first, the S&P 500. 500 are America's largest companies and the benchmark for generally the global investment industry and people that invest look at overall. When you look at the full history, nearly a century of data, the long run direction is really clear, continuously upwards. But if you zoom into any individual crash, and the picture changes completely. So let's go threshold by threshold. The 20% threshold crash, how often and how long? At 20% threshold, the official definition of a bear market, the S&P 500 has triggered this level more than a dozen times since 1927. But here's what is striking. When you look at the recoveries, most are actually fairly short. The average recovery from a 20% plus decline, excluding the Great Depression and this dot-com and financial crisis period, is roughly 2 to 3 years. The 5-month recovery for COVID is this extraordinary measure, a crash that happened in 33 days, driven by the global pandemic, and then reversed in under half a year. That's definitely not normal, and that highlights how these crashes can act in different ways, which is particularly interesting. And it tells you something really important. The nature of the cause matters more than the size of the drop. Now we look at the 30% threshold. Immediately you see that there's fewer events that actually cross that 30% crash. And the shallow bear markets, the ones between 20 and 30%, that generally recover in a year or two, have disappeared. What remains are the more serious crashes. We see the 1973 oil crisis, the dot-com collapse, the 2008 financial crisis. These are the ones that reached over 30%. And the 30% threshold starts revealing a really important pattern. Crashes driven by genuine economic damage, structural problems in the economy, take significantly longer to recover than something like an event-driven crash. Black Monday in 1987 was a massive crash, but it was some kind of technical collapse. Programmatic trading, feeding on itself, but otherwise the world's economy was pretty healthy. And so it only took 2 years to recover despite the crash being very large. Meanwhile, the dot-com crash was a massive valuation bubble that destroyed real capital. Companies that generally had no business being worth what they were worth meant it took much, much longer to recover. And finally, we look at the big one, the 50% threshold, and we see that there's actually been very few of these events in the S&P 500 over the last 100 years. And these are crashes that generally you're going to get taught about in the history books because they're catastrophic. We see that there's a 50% crash in 2008, which definitely was catastrophic, which took about 5.5 years to recover. And we see that the 49% crash in 2000 was slightly smaller, but it took around 13 years to properly recover because of the amount of damage it did. The 49% crash in 2000 would have probably recovered a bit faster, but technically because it kind of then fed into the 2008 crash, took longer to recover than it would have done otherwise. So the size of the crash doesn't really seem to determine the length of the recovery. It depends what the structural issues were with this crash in the first place, and how that leads to kind of longer term damage to the global economy, in how quickly the stock market's going to rebound. I think the pandemic in 2020 is a really good example of that, because it was something outside of the world's financial systems that caused them to crash. So once the pandemic had kind of stopped, the world was able to continue almost as if it hadn't stopped in the first place. And that's why it jumped straight back up to where it was before. And I think it's interesting then to look at what else is going on in the rest of the global economy. A lot of investing content is American, and I'm interested in other markets such as the UK. As someone that likes to invest globally, I like being aware of all the different kinds of stock markets that you can invest in. That's the thing. When you're talking about most of the time stock market recovers, we've got quite a lot of evidence from the S&P 500 and from the American stock market that it seems to almost recover reasonably quickly after every crash that's happened over the last 100 years. But what if we were looking at the Japanese market or the British market? And this is where the data tells a bit of a different story on recovery. I've got data on the FTSE 100 going back to 1984, and we can see at the end of 1999 it hit around 6,930 points, which is an all-time high at the time. But at the 20% threshold, the FTSE had multiple significant drawdown events, and the recovery times are generally been slower than the S&P 500. And we can see that the dot-com recovery is really important. The FTSE 100 technically crossed back above its 1999 level briefly in 2015, but it spent much of the following years below that again, only kind of breaking through around 2017. I think the critical issue here is that with the FTSE 100 is that on a pure price basis, which is what the index number shows, it's not been particularly rewarding investment over the last 25 years. And some of that may be driven by other returns such as dividends, which I'm not including here. The FTSE 100 has had a historically high dividend yield, averaging around 3.5 to 4% a year, and on a total return basis, the picture is much better. And that's where context matters massively when comparing markets like for like. All I'm interested in here is kind of the recovery time between each of the crashes in the FTSE 100, not the kind of total return that you might be getting if you looked at it. But the lesson for the UK investor is still this: if you owned a FTSE 100 tracker in 1999 and you didn't reinvest your dividends, you essentially broke even in price terms over 25 years. You still definitely underperformed the S&P 500 over the same period. And now we need to talk about Japan. In 1989, the Japan stock market was the largest in the world. Not the US market, Japan. 32 of the world's 50 largest companies by market cap were Japanese, and the Japanese banks held more assets than any banks anywhere on earth. And the land under the Imperial Palace in Tokyo was estimated to be worth more than the entire state of California at the time. And we're looking at Japan, it doesn't matter which threshold you choose. The 1989 crash was so severe that it blew through every threshold simultaneously, and the recovery took the same amount of time regardless. The Nikkei 225 did not close back above its 1980 peak until February 22nd, 2024, really highlighting just how bad the Japanese stock market suffered over these last 34 years. So let me put that in human terms. Someone who invested in Japan's index in 1989, at the very peak of what appeared to be the world's most impressive economy, waited 34 years to break even in nominal terms before inflation. If you then adjusted for inflation, they never would break even. And that's probably the most important data point in this entire video, because it really goes to argue against the argument that markets always recover. They do recover, but that timelines is really going to matter. The S&P 500 has been somewhat of an outlier in the fact that it's been able to recover reasonably quickly after each of the crashes in the last 20 to 30 years. But other markets such as the FTSE 100 and the Japanese stock market haven't recovered quite as quickly. And so you've got to be really careful about just believing in that. They will recover, but as with any investment, there's no guarantee on when they'll recover. It's interesting to see here that some crashes are local and some are global. The world's major indices during the same periods, you can see something pretty interesting. The same event hits different markets very differently, and the recovery times diverge significantly. The dot-com crash started in America but spread globally, and it played out very differently. The S&P 500 and FTSE both took around 13 to 15 years to properly recover, largely because they were immediately hit by the 2008 financial crisis. The Nasdaq, which was the original bubble and was the bulk of the tech stocks, took the full 15 years. And even today, there are individual technology stocks that peaked in the year 2000 that never returned to the levels they were at before, although some have vastly blown past that. The 2008 financial crisis was different from the dot-com crash. It generally was global and driven by banking systems and derivative markets that spanned every major economy. And the recovery times across all markets reflect that. The US recovered fastest, roughly 5.5 years, because the Fed's intervention was the most aggressive. Quantitative easing, near zero interest rates for a decade, direct bank recapitalizations. Europe took longer because the Eurozone had the sovereign debt crisis kind of after it, which acted as a second wave, impacting recovery, with places like Greece, Spain, Portugal and Ireland all nearly collapsing in 2010, 2011, 2012, which essentially delayed the recovery. And Japan, which had already been a bear market for 19 years, when 2009 financial crisis hit, simply kept going down and didn't even start to recover until recently. And then there's the outlier, COVID-19, which is definitely an outlier for these patterns. In this, the US recovered fastest, with Japan also recovering surprisingly quickly. The UK really struggled and recovered slower. The FTSE 100 is heavily weighted towards energy companies, mining companies, and traditional finance companies, all of which struggled far longer with the disruption COVID caused than tech companies that make up most of the S&P 500. The FTSE had less of the work from home winners that powered the American and German recoveries. And this is the broader lesson about thresholds. The same percentage drop can take dramatically different amounts of time to recover, depending on the composition of what crashed and what drives that country's stock market. And all right, probably the most interesting session. Does spreading your investment out over that crash period actually help? Let me be very precise about the test we're running here. This is not just dollar cost averaging every month for 30 years, which I'd probably recommend doing generally. We're just doing, have you just put in a lump sum and has the market just crashed? Do you put it all in today or do you spread it out over the duration of the crash until recovery? Does it make a difference? Both strategies invest identical total amounts. If a crash lasts 7 months, the lump sum goes in on day one. The dollar cost averaging plays 1/7 of the total each month. And here's the advantage dollar cost averaging might have. When you invest a lump sum on the day of the peak, every pound or dollar you invested is buying at the highest price. As the market falls, you watch the entire investment sink. The DCA investor spreads their purchases. Their first payment buys at the peak, but then as it falls, you're buying at a lower known price, and then you're buying as it goes up as well, meaning you're buying more shares for the same amount of money. This creates a lower average cost per share, and that lower average cost means the DCA investor typically reaches break even before the market fully recovers. And we can see here the lump sum investor took 5.5 years to break even. The DCA investor broke even roughly in roughly 3.5 years, about 22 months faster. Why? Because the DCA investor average purchase price was significantly below the October 2007 peak. They bought through the decline, accumulating shares at every price level on the way down. So when the market recovered, it did not need to return all the way from the peak to the DCA investor to be in profit. Therefore, the DCA investor cut the break-even time roughly 40% in the 2008 crash. I think you're unlikely to probably have put in a large lump sum just before a crash, but I think it's useful to look at data and understand just how long it would take to get that money back if it did, on average. I think for me, the best method is just to continuously dollar cost average in if you're accumulating wealth, if you're paying in some money from your paycheck, paying money into your pension every month. I don't think you've got anything to worry about. You just keep doing it and it should work out. You can't really try and time the market, and that's the problem with the lump sum is you could put that lump sum in and have a massive crash and then have to wait for it to recover, or you could put the lump sum in at the bottom of the market, get incredibly lucky and gain a massive return really easily. But you can't time that, and I think it's very risky to try and time the market in that way. Dollar cost averaging works because you're not trying to time the market, you're just putting the same amount in every month, again and again and again, and you're riding that wave. So when the market goes down, you're able to buy more for that same amount of money. When it goes back up, you're still buying more for that money because it's still below where it was before, and then it averages out and you essentially gain money that way. So I'd recommend doing that. There's no point trying to time the market. You're only going to probably guess wrong, statistically speaking. So we've covered a lot of ground. Let me bring it together. I think this data generally teaches you things that are easy to say, but harder to really internalize. The threshold really matters, but less than the cause. So the difference between 20, 30, and 50% crashes is enormous in terms of the gain you need to recover, but the recovery time is more determined by the cause of the crash in depth. For example, the COVID crash is very different to the financial crash in both how it affected the world, but also what caused it, and that led to the crashes recovering in vastly different ways. So I think if there is a crash, really think about what is driving that crash, and that will probably give you an indicator on how likely the market is to recover quickly or not quickly. I think it's also useful to see that the same crash hits markets very differently. The 2008 financial crash crashed the S&P 500 and the FTSE pretty similarly, but they took different amounts of time to recover. Dollar cost averaging is really useful to continuously pay money, and that kind of helps soften the impact of any massive crashes. I think it's better to not bother timing the market and just keep paying in if you've got regular cash flow. It's not going to magically solve a crash, but it's going to soften the blow and help climb out of it as the market goes back up. Obviously, if the market's down for 15 years, that money's not coming back anytime soon. But I think the worst thing you could do is take your money out of the market. It's probably best to leave it in there or leave it in the markets, let it grow, let it come back. Because it's very likely that if you're a global stock market investor, the global economy is going to continue to grow and you can benefit from it that way. There's just no timeline on when it will come back. And I think that's really important. Your investment horizon is most important at all. We've seen here that the crashes generally take around 5.5 years to recover. So I think you want to be invested for at least 5 years or longer to make sure if there is a crash, the stock market's likely to recover mostly to where it was before or further in that time. But obviously that's no guarantee. In some instances, it could take 10, 15 years to properly recover. But I think, as with anything, never invest money that you are going to need relatively soon, and it's money that you can afford to lose. If you leave it invested, it's very likely that at some point you'll recover and you'll get the money back, so it's not gone forever. But at the same way, it potentially could be gone forever as well. I hope that video has been really interesting. It's really interesting to see how the S&P 500 differs from the NASDAQ, from the NIKKAI 225, from the FTSE 100 and the FTSE 250. I think it's really important to highlight how these crashes vary, and I think you're never going to be able to know when a crash is going to happen, but it's important to understand how the size of that crash, how big that crash is, and what's caused the crash will help you kind of make informed decisions about how you go about continuing to invest going forward. I think the worst thing you can do is not continue investing and to take your money out. Those are two things you should never do. I think, as with anything, the data here has shown that all these stock markets have eventually recovered once they've had a crash. It just depends how long they're going to do that and how well they do that. Anyway, I've got more videos on the horizon. Stay tuned. Please like and subscribe for more stuff like this, where I use a data-driven approach to answer your financial questions. Thank you.